What's up guys, I'm Grant. Back in 2022, I blew through $650,000 and had to rebuild from zero. So I don't waste any time on theory. Now, the market's been turning green these past few days. Russell's up about 1%, Nasdaq's pushing higher, S&P's green and VIX is back around 15. People are starting to feel safe again, but this is exactly when I slowed down. Today, I'm not talking about what stock to buy. I'm going to talk about how traders should actually behave when the market looks strong, but the risk hasn't disappeared yet. Because most people don't lose money trading badly on red days, they lose money trading recklessly after the market bounces back. So let me break down why green days mess with your head. A few days ago, everyone was doom posting, talking about worst case scenarios. Now, after a couple of green days, the whole vibe just flipped. But guys, this is the same market, same risk, only the emotions changed. Here's what people don't get. A bounce just means panic paused and it doesn't mean risk vanished. This is when traders start doing stupid stuff, getting back into positions too early, sizing up without clear reason, FOMOing into names that already ran away too far. Before I go on guys, if you found this useful, please make sure you're subscribed. This channel is just me sharing lessons that I've learned after losing money myself, and this isn't financial advice at all. It's just my personal way of thinking so you can decide what makes sense for you. Alright guys, rule number one, it sounds simple but it saves you a lot of money. Just because a stock looks okay doesn't mean you should buy it. Now let me explain what I mean. Let's take AMD for example. The structure looks fine, buyers are showing up again, nothing looks broken on the surface. But that doesn't automatically mean I need to be in it. Your portfolio does not need every stock that looks decent. Sometimes the smartest trade is literally doing nothing and waiting. So what I do instead is separate two ideas in my head. This stock is fine and this stock actually fits my strategy right now. Now those are not the same thing. I ask myself straight up, why do I need to get in right now today at this price? If I don't have a clear answer, I just wait. There's no rush. And here's what you don't do. You don't buy just because it looks cheap compared to before. You don't jump in because everyone's talking about it, and you definitely don't trade because you're scared of missing out. FOMO is how accounts get wrecked. Having a plan, knowing your levels, and controlling portion size, that's how you stay in the game. Being selective is a position, people. Don't forget that. Now, rule number two is you figure out the risk before you even think about the profit. Most traders do this completely backwards. They see the upside, get excited, and ignore the downside. Don't be that guy, especially in this market. There are a few types of risks that you need to be aware of. First, there's valuation risk, and this is where a lot of people get trapped. This usually shows up when the price is running way ahead of the business itself. The stock looks strong, everyone's bullish, but the numbers underneath, well, they haven't caught up yet. For example, when a company is trading at crazy multiples like 30 or 40 times forward earnings, but revenue growth is already slowing, that's valuation risk. You're basically paying today for results that might not show up for another year or two. So how do I check this? Well, I don't overcomplicate it. I ask myself, what has to go perfectly right for this price to make sense? Does growth need to accelerate, margins need to expand, or guidance need to beat expectations? If the stock price only works in a perfect scenario, that's valuation risk. At that point, even good news might not be enough because expectations are already too high. And second, there's leverage risk, where a company is leaning way too hard on debt, and when conditions tighten, that debt suddenly matters a lot. And third, there's execution risk, and this one is huge. This is when management talks a big game, but the results don't match the words. So what do you actually watch here? Well, you watch earnings, you watch guidance, and you watch what they promised last quarter and whether they actually delivered this quarter. Look, once you buy a stock, you're basically becoming a shareholder, even if it's a small position. That means you should care about what this company is doing day to day. New announcements, changes in strategy, delays, cost overruns, all of that matters because it directly affects your position. If management keeps changing the story, missing targets, or blaming macro every quarter, that's execution risk showing up in real time. And there's also timing risk, where the idea might be right, but the catalyst comes way later than you expect, and you're just stuck holding the bag. Now let's take Oracle as an example. The business itself isn't broken, but the math changed. CapEx went through the roof, free cash flow turned negative, and all of a sudden, debt mattered again. When expectations were crazy high, the stock ripped. When reality kicked in, the market pushed it lower. Now that's not the market being stupid, that's the market repricing, timing and execution risk. For every trade you're in, guys, remember this: every position comes with risk, no exceptions. The real question is that risk something that you can actually handle? Never ever put money on the line that you can't afford to lose. That is the golden rule. And most importantly, cheap doesn't mean safe, and expensive doesn't mean it's not worth it. Just because a stock is down a lot doesn't mean that the risk is gone. And just because something's pricey, it doesn't mean it can't keep growing. Take Nike, for example. It's down big and everyone's asking, is this the bottom? Wrong question, bro. The real question is what's actually changing within the business. Margins under pressure, slower growth in China, tougher competition, and yeah, a new CEO doesn't fix that all overnight. But on the flip side, some things might look expensive now, like gold or high growth names, but the potential for future upside is still huge. Now, cheap doesn't automatically mean safe, and pricey doesn't automatically mean bad. And if the price keeps dropping while the fundamentals keep getting worse, well, the whole story relies more on hope than real data. You'll find yourself constantly trying to convince yourself why holding is still a good idea. Now, if you see that happening, guys, walk away. As long as you still have your capital, there's always another trade, guys. All right, if you actually got what I just said, here's what you should do next, trust me. First thing you need to do is sit down and review your current portfolio, like every single position. I asked myself straight up, why did I even enter this trade in the first place? Does that reason still make sense right now? And if I didn't already own this stock, would I honestly buy it today at this price? And you've got to be real with yourself here, guys. If your answer is, not sure, or I hope, well, that's already a red flag. Hope is not a strategy, and the market doesn't care about what you're hoping for. Next thing, and this is huge, you need to understand the difference between a technical bounce and a real fundamental change. Because a lot of people actually get these mixed up. A technical bounce is when price looks better, charts look nicer, but nothing actually changed about the business. It's just price moving around. Now, a fundamental change is when real data shifts. Earnings improve, guidance gets stronger, demand shows up, and market share grows. Now, that's real change. Look at Nvidia, for example. Every time it dipped, buyers stepped in. Not because it was cheap, but because the company had pricing power, clear demand, and insane execution speed. When a business has that kind of control, fear doesn't really stick around for long. So what should you actually focus on here? Don't just chase price because it's going up. Wait for clear signals that demand is real, not just a bounce, and confirm it with volume, confirm it with structure, and don't rush in just because you missed a couple of green days. Missing a move sucks, yeah, but losing money because you chased it is way worse. If you're not sure how to read the charts, please drop a comment and I'll answer your questions. And now the third thing, and this one is non-negotiable, is you set your rules before you enter any trade. As I said before, every time when I click the buy button, I already know when I'm getting in, when I'm getting out. If I'm wrong, there's no excuses, no moving stops, and that's what my target is, based on risk and reward, not emotions. I also know what kind of situation would make me want to exit, not just a price number. Here's my golden rule, and I really want you to remember this. If you can't explain why you're taking a trade in under 30 seconds without using words like hope or maybe, don't take it. Seriously. The moment you use those words to justify a trade is not a trade anymore, it's a gamble. Now let me clear something up because people focus on the wrong things all the time. 1 or 2 green days in a row, nice headlines, people online saying the market is safe again, well, all of that feels good, but it doesn't actually mean much. That's noise. What actually matters is where real money is moving. I'm watching volume. Is real money coming in or is this just short covering? I'm watching sector rotation. Is money flowing into growth or hiding in defensive names? Because that tells you how much risk people are really willing to take. I'm also watching the VIX too. Is it dropping because confidence is actually coming back? Or is it just people getting complacent? And those two things look the same on a chart, but mean very different things. And I'm always paying attention to credit markets. Are spreads tightening? How is corporate debt being priced? Because that's where real risk usually shows up first. Just take a look at what's happening right now. VIX around 15 sounds calm, but that doesn't mean risk disappeared. It just means people are relaxed for the moment. Russell being up around 1% looks nice, but small caps only matter if that strength actually sticks. One quick pop doesn't prove anything. And if big tech is the only thing running while everything else is flat, well, that's selective strength, not a real broad recovery. And selective strength, well, that can disappear fast. So don't just look at what's going green on your screen. You must pay attention to what's actually moving and, more importantly, why it's moving. All right, guys, let me wrap this up. The market looks better than it did a few days ago, that's for sure. But better doesn't mean safe. Do not confuse the two. The most important thing you need to do right now isn't finding stocks to buy. Every trade has its risks. The question is, it's something you can actually handle. Set your rules before buying and know when to exit, and don't mistake a bounce for risk disappearing. If you can name the risk, you can manage it. If you can't, the market's going to teach you the hard way. Trust me, I've been there. For me, there's no rush. Staying calm, staying sharp, and waiting for clean setups, that's already an edge. That's how you survive when everyone else is losing money. Don't forget to subscribe and turn on notifications. Hit like and save if you found this useful. I'm Grant, and I'll see you guys next time.